using this as an opportunity to keep spending more. So this is a big problem. I think you're getting the drift here, that we need some significant action here. If you think of real interest rates, they've now have gone negative. So if you look at this chart, you can even go back to the mid-'80s, and if you bought a fixed income investment, you'd be earning about 4% over inflation. So even if inflation was running at a higher level, you're still making about 4% real return. Not bad. Today, and as you look at this chart, you can see that real rate of return, the difference between what you're getting posted on your GIC or your bond or your savings account and the actual inflation is gone negative. So when you invest in most fixed income investments, you're getting back less than what you put in terms of purchasing power. And so that's a serious, serious problem. And I would ultimately argue that's immoral, not to reward savers properly and the capital builders. And it's going to hurt us long term. It's actually going to drive the problem in the wrong direction. This also, again, emphasizes what I've just said, that if you look at this is the U.S. domestic capital spending. So you can look at the capital spending. So this is the long-term investments in big capital projects. And over the last number of years, you can see in the U.S., same thing in Canada, same thing in the developed world, people aren't investing in big long-term projects, and that has come down. Over the last 5 years, in the midst of this financial problem that we've been in, this debt storm, that's gone negative. So not only are we piling on debt, we're dissaving. We're not putting net after you've gotten depreciation and you're writing things off. We're not actually putting more money in long-term capital. That, again, is a completely wrong-headed economic philosophy. We need long-term capital investments if we're going to get this thing turned around. The other thing that zero interest rates does, again, you don't make those long-term investments. Businesses don't make those long-term investments. Governments threaten to increase taxes and so forth. You get economies that stagnate. And again, this slide just shows what's going on in Europe. In many of the European countries, the unemployment rate for people under 30, even under 35 now, is well over 25%. For some of the 25 and unders, it's close to 60% unemployment. The youth don't have job opportunities. And this is a recipe for just a horrible situation in terms of social unrest and civil problems. We must have economies that are dynamic to create jobs for the next generation, and jobs that aren't just any old jobs, but jobs that can maximize their gifts and abilities as God has made them. And so this is a problem in a stagnating situation. You don't create jobs for the next generation, and that leads to some of the unrest that you've seen. The next two slides just take us really from the 50s up to the current day that we're in. And the whole point here of these two slides is to show that as debt goes up, growth comes down. Because debt eventually, your balance sheet gets over and over levered, and it ultimately stagnates the economy. We know this. I mean, if you're running your own personal affairs and your debt just became extraordinary, you're going to ultimately have to make long-term decisions that are going to start to cut back your ability to grow and expand and so forth. It just absorbs your whole economy. And so this just shows that as the debt goes up, the growth in the economy comes down. And this takes us up into the contemporary current situation. And most of our economies, if they're growing 1 or 2%, we're fortunate. But remember, we're growing, they say, 1 or 2%. But we're running in the United States and much of Europe 5, 6, 7, 8, 10% deficit to GDP. So we're needing to go into deficit just to keep us above the trend line, just above the zero line. Again, that is not sustainable. And then this last slide here in terms of zero interest rate policy, ZIRP, as I said, this is a massive transfer of wealth from savers to debtors, and the worst, it's supporting very bad government decisions. And central banks are manipulating and fixing really interest rates. And remember, when you fix interest rates, you fix all of the prices in the economy. And in the United States, I just give you this example, and I have this listed on the bottom of this slide. In the United States, the amount of interest that is earned on interest-bearing securities has dropped by over $550 billion from 2007. So if you take the period 2007 and you added up all the interest that was earned by Americans, and then compare that to what they earn in the same investments. In fact, there's more interest-bearing securities now in the marketplace. It's dropped by $550 billion. This is a wealth transfer from savers to debtors, and it's huge. Again, I just give you a flavor of the gravity of what's going on given the economic policies. And then the last issue I'll touch on quickly, and this really is just money printing, and I think most of you realize the danger of this, particularly if one gets addicted to it. It's one thing to say that you use a little new money to try to help a situation, to get yourself out of a problem. It's another thing when this becomes, if you will, almost like a cocaine addict, and we become dependent on the money expansion of the money supply, and there's no checks and balances here, really. And so I'd ultimately argue that this quantitative easing is euphemism for just printing of money. It's really a debauching, if you will, or a debasement of the currency. And this is a serious problem. In the United States, just to give you a sense of what they're doing down there, they printed about $1.3 trillion back in 2009. They call that QE1. QE2, this is not Queen Elizabeth, the quantitative easing. And QE2 was $600 billion. QE3, which they started last year, $40 billion a month they started printing money. And QE4, which they just announced in December, is QE3 plus $45 billion. So now they're at $85 billion a month, or over $1 trillion a year in just new money. And remember, when this crisis first started, the money supply in the United States was about $800 billion. So they're planning on printing this year more money than the total money on the balance sheet just back in 2008 on the Federal Reserve. This is aggressive, people. This is really aggressive, and it's not sustainable. I just put up here Bank of England, that's BOE, the Bank of Japan, the ECB, which is the European Central Bank, the Swiss Bank, the People's Bank of China, the PBOC, are all expanding the money supply, all of them. And in fact, there's no cap on the money supply expansion at many of these central banks. So if you think about these numbers, if you put all of the major central banks in the world, and I have a slide a little bit later on this, but I'm just going to fast forward through this, they've gone from about $3 trillion post-crisis in 2008 on all these balance sheets to over $13 trillion today. So that's a big increase in the money that's gone into the marketplace. And at some point, one has to be concerned about how that will impact pricing and inflation and debasing of currencies and so on. This slide just shows that every time they announce this QE, the stock market tends to go up. And the stock market kind of likes this because it just gives them more money to bid up the prices of assets. So in some cases, printing money can put the prices of some securities up and benefit some people who are ahead of the game. But for the average person, it just leads to inflation and a loss of purchasing power. In case you go to the Federal Reserve and you have to wait a little bit to get your money, it might be because they're printing it. So this is just having a little bit of fun about a serious situation, but sometimes you just have to sit back and look at this because you can't believe what these people are doing and how you can just make little step after little step after little step and end up in the situation we're in. This slide just shows that the Federal Reserve, the ECB, the Bank of England, and the Bank of Japan, you could see the expansion of the money that they've put in the system over the last number of years. And so I'll leave it at that because I talked about that. What does this mean from an investment perspective? Briefly, as we just, again, draw to a close and have some conclusions here. From an investment perspective, what does this mean when you've got all of this debt out there and you're trying to be responsible, you're trying to be careful, you're trying to pay your bills, you're trying to be a wise investor and so forth? Well, from an investment point of view, you're going to focus on the preservation of capital. You're going to try to get some growth of capital in real dollars. That means you can still buy real things to the same extent that you could, and you're not going to be impacted by inflation as much. Tax efficiency is going to be important because governments around the world are largely putting taxes up. They're not really fixing their spending problem. They just think they can get more money out of the productive class. Creating a steady, sustainable, tax-efficient income streams is very important, especially for older clients, as they see their investments not producing the same kind of returns. They want to be careful not to take on too much risk. And you want to have flexibility of account. In other words, you don't want to be in too many accounts that have you all locked up. And that's important. And so what we're doing, what I would make a very strong suggestion is that you must invest in quality. And so we look for, again, powerful companies, brand, franchise, balance sheet strength. So these are companies that have, lower debt, controllable debt, and it's well structured, if you will, when it comes to financial terms. High barriers of entry into these businesses. So they're in industries that are scarce, strategic. I'll say just a little bit more about that in a second. Essential businesses, businesses like the energy industry, food, healthcare, staples, basic consumer products, water. Water is a huge area. We actually focus a fair bit on this whole area of water because of the long-term demands in this industry. Infrastructure assets, those core productive assets that you need regardless of how crazy certain monetary policies may be. Industrial and utility businesses. And we look for, as we say, tangible or hard assets. We want businesses and assets that are not as currency-based. In other words, they're not based upon just the money that the government can print, or they're not based upon promises that could be defaulted on. You're always thinking through, who's on the other end of this investment? Can I trust them? Will they deliver what I'm expecting in terms of investment? Understandable business, track record has to be successful, high returns on invested capital, and of course, management experience. Whenever you're looking at investment, it's all about management experience. Because I've painted a situation that says, you know what, we're going to be in for a bit of a shakeout. This debt storm is ultimately going to hit us. It's coming upon us. And in light of that, you want to make sure, like from a financial perspective, your money's invested with people who can weather the storm, actually take advantage of the storm, and perhaps be able to buy assets up and expand their business on your behalf as a shareholder. So when we're looking at different sectors that we're investing in, we're very careful in the financial sector because of the debts, as one would expect. So we look for financial businesses with very low leverage, more fee-based businesses. We'd stay away from, some of the financials that have long-term exposure to bonds and things like that. Key commodities. We're blessed here in Canada with some wonderful, wonderful assets and reserves. So as Canadians, I think we can make significant investments in certain industries with relative degree of safety vis-a-vis the rest of the world in other sectors. So energy, oil, natural gas, agriculture, water. These are, Canada's blessed with tremendous agricultural assets, water assets, businesses like fertilizer companies and so forth. Consumer staples, healthcare, basic healthcare businesses. Precious metals, I think, is a very important area to have some assets in. As I always tell investors, I'm not a gold bug, but when you have the kind of debt levels that we have in our society and the promises that the government's made, it's virtually impossible that they're not going to debase currency, and therefore you try to invest some of your assets in things that can weather debasement. And clearly, the monetary assets like gold and silver fit the bill, if you will. Real estate, hard infrastructure like roads, ports, hydroelectric, timber, wireless towers. These are all wonderful assets that, again, if we change a currency or we have to have a reset in debt, you need your railroads, you need your timber, you need wood, you need your roads, your ports. All of these things get repriced and can weather some pretty volatile situations. And history has borne this out. In the last area I just mentioned, industrials like the railways, pipelines, heavy equipment, waste disposal, and recycling. What you're trying to do is, given all this debt, which at some point has to go away, and I'm not going to tell you how it's going to go away. I mean, they're going to try to debase it away in a very orderly fashion. I'd suggest that in history, you can never debase this much debt away in an orderly fashion. And we shouldn't expect them to be able to do it. I think that's a situation that's impossible. So what it means is currency and fixed income kind of investments are going to be under massive pressure. In fact, some cases could be wiped out in terms of value. And so you want to take that paper value you have today and make sure a chunk of it, a good chunk, is in assets with staying power. They're essential, they're scarce, the world needs them, and the world will continue on. And